Hi, I'm Kep Kepner, CPA here in Dallas. We're talking about one of my clients, and we're calling him Alias Roger. He earned enough money so that he ended up paying $300,000 in tax. His earnings were in the top 1% of all the taxpayers in the United States. And so we had a conversation about, well, what can I do about it? Well, one of the things has to do with how you allocate your earnings between earnings subject to Social Security and Medicare and earnings not subject to Social Security and Medicare. Let me give you an example. Let's say that you made $100,000 in your business, and that was profit. Well, your profit is subject to income tax. If you pay yourself a salary of $50,000, your salary is subject to Social Security and Medicare, and the remaining and income tax. The remaining 50 is subject to income tax. So by paying yourself a salary, you actually pay more overall tax. Now, Uncle Sam understands that, and they expect the owners of small businesses to pay themselves some salary. And it's kind of an arbitrary kind of calculation. It's not a formula. It's kind of like, what would you pay somebody to run your business? So it's arbitrary, and you can pick a number. But the reality is, the more you have in salary and the less you have in profit, the more your tax goes up. So with Alias Roger, we had this discussion because he pays himself a fairly low salary. And in fact, he probably should pay himself a little bit more in salary, which means his tax is going to go up. But we're managing his tax bite against the possibility of getting audited. Being audited is an expensive proposition for anybody. It's emotionally draining and it's expensive, even if you don't owe more tax. So for my client, Alias Roger, we have to work through the issues of self-employed earnings versus regular earnings, and that will have an impact on his taxes. And it also is affected by whether he wants to contribute to a pre-tax retirement account. Let's take that example again, $100,000 in profit. If it's not subject to self-employment tax, then you can't contribute to a SEP or a 401k retirement plan because that's based on your self-employed income. You can still do an IRA or a Roth IRA, but you can't do larger amounts of contribution to your SEP and to your 401k. So there's a balance. The more I pay myself in salary, the more tax I pay in Social Security and Medicare, but the more I can put in a pre-tax retirement account. So it's a complicated calculation, and most financial planners don't really think about that. They just think about, well, you need to save for retirement. And that's right, you do. But maybe in a pre-tax retirement account, maybe that's not the best way to do it. Maybe reinvesting in your business is better, or investing in other things. So let's talk further about Alias Roger and his tax opportunities. We can help you in that area. Give us a call. Thanks.